Well, good afternoon and welcome to the quarterly town hall for the Wealth Stewards. For those of you who may not know, my name is Jeff Breese, one of the managing partners here, and I am glad to be with you all, as are team members of ours from across the building and soon to be across the country. So we'll talk a little bit about that. We are very grateful for everybody's time and attention. If you have been to these before, you know that what we try and do is condense down a lot of information that we think is important to you in this quarterly cadence and share some relevant updates from our end, from the market, share some knowledge, and end with a Q&A session. So the first thing as your moderator that I'll tell you is I will be monitoring the Q&A for the session. And if you have questions, we will save those until the end of the presentation. And so I'm glad to kick it off for us. If we can look at today's agenda, I'll take you through that and make some opening comments, and then I'll be transferring it to different team members. So today's agenda, if we can have Chris move that forward for me. Great. Thank you, Chris. It takes a real team to pull this off. So Chris is in the background doing heavy duty lifting for all of us who might be technologically challenged. And that comment is made towards me. So today's agenda is some opening remarks that I'll make and essentially to focus on 2025 and then to move us through to 2026 and some important commentary. And from there, we'll go into a couple of updates of the firm overall, which I think will be fun and exciting and important, hopefully relevant to many of you. Brent will then take us to a market update and some interesting points and some updates from recent work with our outsourced teams of investment, capital and analysis that we use at Fiducian and the back office at Concurrent Asset Management. And then we'll shift it over to Ryan, who will talk about some tax stuff, changes, rule changes, limitations, and stuff to consider for tax season, which is quickly upon us. And we're fielding those requests from you all related to taxes more and more. And we'll look forward to helping you through that process, just like we as tax filers are doing it ourselves. We'll talk with Cyrus a little bit after that about some ideas for those of you, or maybe some of you who know people who have concentrated holdings. So this will be an idea generation type of part of the content where we'll maybe plant some seeds for you or people you know and talk to you about some strategies there. And Cyrus will guide us through that. And then, of course, as I said earlier, I'll lead us through the Q&A. We'll try and get out of here, as always, in 40 to 45 minutes at the longest, I think, and try and hold before that if we can. I wanted to make a couple quick comments about 2025, and we can stay on this slide. It's no problem. When I think of 2025, there are a couple things that stand out for me. As a parent of two teenagers for the first time in 2025, I will never look at the number 6, 7 the same again. For those of you who know, you know what I'm talking about. I thought of the concept that instead of quiet quitting, which used to happen during COVID, there's now a term called strategic underperforming, where people are in the workplace doing some interesting things. And then I think the most important thing, if you look on social media, for those of you who do and maybe do too much, but what I learned that the definition of being a long-term investor, according to 2025 and social media, can range anywhere from being invested for 6 months to forever. And so that's an interesting take. But most importantly, I'm reminded that in 2025, we were reminded with the way that the market played out, that having a plan is vitally important because the market moves faster than our emotions. And in particular, the parts of 25 that really brought this to the forefront. And we walked many of you through what were some interesting times, and yet was a great example of how having a long-term outlook and tying things to a plan really mattered. So those are my comments for 2025. We'll move on to 2026 and get moving in that regard. So it's my job to talk about 3 things related to the firm. One of those is that we have announced, if you follow us on social media, particularly LinkedIn, we announced that we are opening an office on the East Coast, and that office will be open effective mid-February. In fact, today we hired our first staff person for that office. I will tell you that we have an advisor joining us in mid-February from another firm, and I can't announce that yet for privacy reasons. But some of you know that myself, Brent, both have roots growing up on the East Coast. We have clients now in 30 states. It might be more than that. And so we are truly a national firm. And to represent our expansion of not only the firm, but our presence across the United States, we're going to have an office in Massachusetts effective, again, mid-February. So we're excited to announce that. And I think for those of you who might have people that you think are in your atmospheres that we might be able to serve that could get a similar experience and outcome, if you've enjoyed it, hopefully you have. We have an exciting opportunity to have additional capacity across the country, but specifically in the Northeast to help with those people that you might want to make introductions to that want a more personal approach rather than a firm that's 2,300 miles away in Arizona. So that matters to you. We're glad to announce it. And more information to come. And please, if you don't follow us on social media, particularly LinkedIn, please do. The second thing I want to announce is it's an interesting development. And that is one of the things we try and be here is very humble about the work that we do and the successes that we have. And in our advisory board meetings last year, one of the things we found out is we're actually having these successes where we're winning these recognitions and awards, and not everybody knows about it. And the reason it's vitally important to tell you about these things is because these awards and recognitions come from all of you. We do not exist without the implicit trust and the journey with all of you who are on this call. And so our success is your success. And so I want to highlight a couple of those because since we've entered into the Wealth Stewards in its current format, we've had great milestones. And I just want to highlight those for you. For example, in the end of 2024, we were named by Forbes magazine as a best in state wealth management group. In early 2025, I was named as part of this team as the number 23 advisor on Advisor Hub's Advisors to Watch list. And that was out of 250 advisors that they even recognized throughout the country. We were named in April or May of last year at Concurrent, our back office partner, as a peak performer, which only goes to the top 10% of firms affiliated. In December, we found out that, in fact, in our ecosystem at Concurrent, again, our back office partner, of over 50 teams, we were the fastest growing firm inside the ecosystem for 2025. And that's a remarkable achievement to celebrate with all of you and to let you know of. I think probably the coolest one that we sort of geeked out about here at the end of the year was that in December of 2025, we won an award called November for Others. And again, of all the practices affiliated with our co-op, if you will, our back office of Concurrent, we were the winner of the November for Others award, whereby we strategically and repeatedly went out to the community here across Arizona with all the might of the team here in Scottsdale and in the Valley and did charity work. And in fact, we now have an award sitting on the entryway of the office when you come visit. That is not only a November for Others Champion Award, but some of the medals we got from the charities that we actually help. So again, the give back to the community is part of everything that we do. And sometimes we're not sure we highlight that enough. I will highlight as well is that we did have significant contributions at the end of last year to our premier partner in charity, and that's St. Vincent de Paul here in Phoenix. And so for those of you who helped support St. Vincent de Paul alongside of us at the end of last year, we're super grateful for that work as well. So that's the recognitions and awards. I will stop bragging about us, but I brag in a humble way and in a way to show gratitude to all of you on this call who have helped us along the journey realize those awards, and hope they mean something to you as well, because you're definitely a strong part of them. And they're all over the office now. So no matter where you go, hopefully you see some reminder of what you're helping us build and the fruits of that labor. The last thing on my agenda in this first firm update is to talk a little bit about the 2026 calendar for the Wealth Stewards as a firm. And I will tell you that we have a robust client outreach plan, marketing plan, and calendar for 2026. I will give you, I can't give you all the dates because it would take up a half an hour, but I can tell you that this advanced and enhanced calendar and outreach centers around three things. One, enhancing the education opportunities to clients and prospective clients who want to entertain and see the full might of the firm and what we do. The second is connection. How do we connect more with people in our ecosystem, particularly you as clients, to make sure that we do fun things together? We continue to recognize that our relationship is the most important factor in continuing to care for and with each other. And then some opportunistic types of events where we'll be doing events that we've never done before. And Ryan and Cyrus will perhaps talk a little bit about one element of that. So if you would just, take a bullet point with you leaving today's call, that 2026 will involve more outreach to you all with invites and opportunities to opt in back with us. And we do those only in response to the request for these types of things and in the spirit of generating an even stickier relationship between all of us. So hopefully you enjoy them, and we're welcome to feedback on all things, those that we're doing and those that we might do, from all of you at any time. And so with all of that said, and keeping on agenda, I would tell you that is in fact time for me to turn it over to my good partner, my good friend, and somebody that I'm intimately involved with personally, professionally, socially, and glad to be so. I'll turn it over to Brent. Brent, can you take us through the next part of our town hall?
Absolutely, Jeff. Before we talk about where we think we may be going in 2026, it is always meaningful to take a step back and look at where we came from in 2025. Those of you that joined us on these town halls last year will remember this mantra. There was three big themes that we had last year, and first was fragility. That we felt that concentration, particularly in the S&P 500, was very significant. There were still some inflation concerns. There was some economic concerns. And that sowed the seeds for volatility. And we did see that back in April in the wake of the Trump tariff announcements. The second is the good news is that there's durability, is that there's protection you can get now that rates are slightly elevated compared to where they were a few years ago at really modest costs. And the fixed income versus 3 years ago when you got absolutely no yield for that and significant downside even as recently as 2022, it could add some protection. Third theme was the age of alpha. And what that meant to us was simply this, is that we went through a very long period of time post financial crisis where essentially you could just buy the S&P 500, buy the index, and that was really all you had to do to get some return. We think now these markets are getting a lot more selective. We think particularly in some of the narrow markets, like emerging markets, like small cap stocks, like alternatives, manager selection matters. Active management actually matters. Passive works in some cases, but really looking for that alpha across these different markets is really important. Let's go to the next slide. So now let's look into the first quarter 2026. What are our themes this year? I think a lot of those 2025 themes really kind of carry over, but obviously it's a new year. We got to have three new themes. So let's go to the next slide, Chris. And that's this. So first is AI. And I think of AI, obviously we get a ton of questions about from an investing standpoint, even from an economic standpoint, what AI is going to mean to us as a country, us as a people, us as investors. And I kind of equate it to this. If had we sat back and spoken in the tail end of 1999 about this thing called the internet, I know I would have definitely underestimated what the impact would have been in our businesses and our lives and pretty much everything. But you had to be really careful and selective about investing in those stocks. In fact, I read a stat a couple of years ago. I think about 99% of the stocks that were high flyers in 1999 ceased to exist. So it was not necessarily the best investment to dive right into it, but it did enhance many other areas of the economy over the ensuing 20, 25 years or so, and made a big impact in our lives. I think AI is going to be very much the same way. In fact, I'm pretty convinced it's going to be the same way. So it's going to impact investing, not just the big names like Nvidia, but also the data center investing, where the capitals are flowing. This really matters, but we have to be aware of getting too concentrated, just looking at some of those specific names and look at what the impact is going to be across the overall economy. This is kind of a continuation of last year as well, of navigating valuation. I think if you're just investing in the S&P 500 right now, what you're basically buying is a high conviction, long only hedge fund where you've got 10 names that are comprised about 40% of that index now. So valuation by any measure, historic and otherwise, US stocks, and there are certain areas of the markets that are expensive. And so we need to be really mindful of where we're investing money with these elevated valuations across many markets. The third one, I don't even know why we put this on here, because if you turn on the news, there's like nothing happening in the world, right? Well, that's obviously not the case. But a key thing that I think that we need to do as investors, when you turn on the news, it's all pretty wild. And it's been wild for the last 5 or 6 years. It's really been wild for like the last 25 years or so. But our job is to cut through that noise, really look what's happening underneath the surface. Investing based on news cycles has almost always, at least in my professional career, and probably going back before that, been a bad idea. So we've got to remove the motion from what we see on the news and recognize that this is an enormously creative country with a lot of great things going on. So really resisting that noise, I think, is vitally important. Let's go ahead to that next slide. Now, along those lines, this is one thing I want to touch on real briefly here. So a lot of people have asked us, okay, well, what do we think this year? Last year was pretty good. It was pretty good against all asset classes. Well, what do you expect for next year? And the truth is kind of more of the same. Now, there's a lot of data on here, but I'm going to try to condense it as easily as I can. Jeff mentioned our partners over at Fiducian. That's our external CIO that we collaborate with very closely. Also, Concurrent Asset Management. We work with them very closely. All of our portfolios and our modeling is built on a 10-year assumption. So it's not necessarily year to year. It's looking across the markets, looking at these asset classes and getting an estimate of how we think these asset classes are going to perform over the next 10 years. So what you're seeing is this. So our year-over-year change in terms of expectations for the future in fixed income is down slightly, but not really that much. It's down slightly because that yield component, rates have fallen a little bit, so there's a little less income to be made from the fixed income markets. That's rolled off a little bit. So of course the expectations for what the returns are going to be in the future have dialed back as well. But again, these aren't massive changes. The other area you see in the red is US equities. So US stocks, we look at a 10-year hold, there might only be a 5.2% rate of return over a 10-year hold that's annualized for US stocks versus last year we were thinking maybe a 5.6. So that reflects what we spoke about earlier was the fact that US valuations they continue to be elevated. So again, we see a minor reduction in what we think we're going to get from that asset class over the next decade or so. Now, conversely, if you remember last January, we really leaned into international markets, and we did that for the first time in a long time. Weren't expecting the timing to happen as quickly as it did, but it worked out really well. Well, our expectations for how those markets, international developed stock markets, emerging markets, are going to perform are actually now better this year over a 10-year hold than they were at this point last year. Real estate in the alternative sleeve. We also think that is going to be good. Broad real assets, we had a big boom in that towards the end of last year. It's kind of continued a little bit into the beginning of this year. Our expectations for return are a little bit more muted. And marketable alternatives, this was the sleeve that actually our alt sleeve, our liquid alt sleeve, which is pretty much in every portfolio, never went negative even during all the chaos we had back in April. Again, changing that is really muted. But if there's one thing that I want you to take home when you look at this, is that we're investing for long cycles. We're making decisions with capital based on long cycles. The adjustments that we've made in terms of expected rates of return, which impact the positive outcome of your portfolios, these are small changes that are made year to year, but there's nothing really massive this year. So if there's one message I convey is I think returns are going to be a little bit more muted. We had a great year last year. We have to set the expectations. Don't know if that's going to happen again. But these adjustments are pretty minor in the scheme of things. We expect more of what we've seen to continue moving forward. Next slide's fine, Chris. Now, what are some things specifically we're looking at? This also kind of rhymes with last year. I think it's a big number. So this year in 2026, there's about $8 trillion worth of US government bonds that are coming due, that are going to need to be refinanced. Now, add to that the deficits that exist in federal spending as well. So you got a lot of money coming on that's going to have to be refinanced here. This definitely trickles across all of the markets, and it's something we're watching. But really similar to last year, 7 trillion of debt matured last year. So it's slightly higher, but not much. So you're kind of seeing a continuation of that theme. But what that's going to do is I do think it probably puts pressure on rates downward. Now that doesn't make a ton of sense to people. We're saying, wait a second, you got all this debt due. Why would it put pressure on rates downward? Well, if you also do look at the news cycle, and in some cases it's instructive to do so, there's a lot of pressure on the Fed now to continue to lower rates. And there's a lot of reasons for that. Typically, it's going to stimulate economic growth across the economy. But also, more importantly, I think for some of these policymakers, is they got to refinance all this debt. And so, to the extent they can push that short term rate lower, it makes it cheaper for the government to do that. Now, the question is, do buyers continue to show up at the auctions to the degree that they have in the past? Last year they did. No reason to assume they wouldn't in the future. But you might even get the Fed stepping in there and adding some liquidity as well. Which, if you recall, back in Q4, we talked a little, or for back in October, I guess, for the Q4 meeting that we did, we talked a little bit about increases that continually happen in the money supply, and this really does kind of drive that. Let's take a look at the next slide, Chris. Now, along those lines, until last year, if you were an investor in international equity markets, It was a really lousy place to be. And last year it was a great place to be. That is largely a product of two things. First, valuation. By every measure, based on data going back 70, 80 years, international markets are cheaper significantly than US markets. But there's another tailwind involved. We also saw the weakest year for the US dollar since the 1970s. Now, all things being equal, if the dollar goes down, the measuring stick gets weaker, and you own something that's not denominated in US dollars, in dollar terms, you've got more money, if that makes sense. So there's that relationship there. And we've come through a period of time. This chart is simply the dollar index going back to post-financial crisis. We're going back to January of 2009, where you had a really strong dollar. That's a major tailwind for US assets. If you're a US dollar holder, you're investing in those international assets, you're investing in something besides the US dollar. As the dollar got stronger and stronger and stronger, that really hampered your returns. Last year, we saw that turn. We think it's going to continue. Typically, these cycles don't happen 6 months or a year. They tend to be multi-year cycles. They tend to last a long period of time. We think that this is going to continue to occur in the next year or so anyway, and it will drive what some of the allocations that we've got in your portfolios are going to do from a performance standpoint. Let's take a look at the next slide, Chris. So this is again, when you think about this chart, I want you to think of the U.S. stocks relative to international developed stocks. So when you're looking at this, upward sloping just simply means that U.S. stocks relative to international peers are like really expensive, okay? And when we came into last year, they were at the most expensive period, most expensive measure that they've ever been at any point in history, which means that US stocks were just priced astronomically more expensive than their peers around the world. Even with the outperformance, which was really significant, we had in our international sleeve last year in our portfolios, US stocks are still really expensive. So it's not something we've gotten some questions from clients saying, wow, international did so great last year relative to the US portion of our portfolio, which also did pretty good, by the way. But you think it's a one and done? Are we done with that this year? And the answer is no. We think this is the start of a big trend. We've got to go back a long way. If you think of that line, it's got to go down to hit that blue line quite a ways to just get back to the mean. So we think there's a lot of room for international assets to run relative to domestic assets. Let's check out the next chart. Now this one's it's inverted, so it's a little bit weird to think about it. But another place, international stocks for us, it was a home run last year. They did absolutely fantastic. We also leaned into small cap a little bit, and that it was fine. It wasn't too much of a drag on the portfolios. But this is something we're really watching this year that we think could offer definitely enhance the returns. Now, what you're looking at is this. When you're looking at this chart, I just want you to think of one thing. This is going back to 1999. When that line goes down, that means that big stocks, think your Nvidias, your Metas, your Googles, your Amazons, are comprising a bigger and bigger and bigger and bigger part of the pie. And what we've got here is we've got a point where the smallest companies in the United States, small cap, maybe going to mid cap a little bit, there is a lot of room for them to grow just to revert to the mean. And when you look at a weakening US dollar, tends to be really good for local markets, which tends to be good for smaller cap stocks. That could be a very good thing. And we also think this push towards reshoring could also bolster the performance of that section of the market as well. So these are some themes that we're looking at over the next year or so. They tend to be broadly a continuation of what we looked at last year. We're not big into big, massive changes, and I think you see that as I go through some of the data. And now with that, I'm going to give the topic that I'm really happy I'm not talking about over to Ryan, and he's going to talk to us a little about some tax stuff.
Hey, thanks a lot, Brent. Did a great job going over the markets. Really fascinating stuff. So enjoyed that a lot. Yeah, so I get to talk now about everyone's two favorite subjects, taxes and dying. What did we call this? Quick takes on the new year for tax and estate updates. So want to just go through and touch on some of these key points so you're aware of these updates for the coming year, things that you're maybe, in the periphery or you're not going to think about until tax deadlines again next year. So want to get this in front of you now. First thing we're looking at is the 2017 tax cuts. These were set to sunset. Originally, these provisions started in 2017, and after a lot of uncertainty back and forth, everyone was kind of curious how this was going to play out. July of last year, President Trump signed the One Big Beautiful Bill, and that extended this. So this was a key takeaway because this is providing stability it gives all of us a little bit more clarity and the ability to do some longer term planning on taxes. So very helpful to know where we're headed on that. You probably were already aware of that one, but want to reiterate. Next is additional opportunities in gifting. So another big thing from One Big Beautiful Bill, this larger federal estate and lifetime gift tax exemption was set sunset as well. That was made permanent. And then in 2026, this increased from just under 14 million to 15, which is a big jump for 1 year. Something I would want to point out for families that have already used most or all of their exemption in the past, this is going to effectively reopen some gifting opportunities for you. So you want to be listening, even if you feel like you've already done that and that ship sailed. You got a little more giving to do. So that's good news. And then for annual gift exclusions, these still remain at 19,000 per recipient in 2026. No change there. Next thing we're going to be looking at, there's this super catch-up contribution in 401k, 403b, 457s introduced from the Secure Act 2.0. And this is for individuals ages 60 to 63. Instead of an $8,000 catch-up, you're able to do 11,250. So something to be cognizant of. In the eligibility for this, they look at the age you'll be at the end of the year to determine that. So something to be thinking about. And the Rothification, I don't know what these words are anymore, of catch-up contributions for high earners. So this is something new that we're seeing. With all of these tax breaks, we had to figure out a way to pay the bills. One of those things is if you're earning in excess of 150,000 in FICA wages, your catch-up contributions starting in 2026 must be Roth or after-tax basis. This only applies with the employer-sponsored plans, so it's not impacting IRAs at all, but something for you to be aware of. Chris, next slide. All right. Charitable deductions. So there's a floor and a cap being introduced this year. Those are the two notable changes for those people that are doing itemized charitable giving. The first of these, the floor, you're only able to deduct charitable contributions in excess of 0.5% of your AGI. And for those of you trying to do the quick math, I'll help you out here. You're excluded on the first $500 of your gifts for every 100,000 of AGI you're earning. So just keep that in mind. And then the second big part of this, the cap. So silly, but those of you in the top federal bracket, your tax benefit on those charitable deductions is capped at 35%, even though your marginal rate's at 37. I guess that 2% is what we're using to keep the lights on now. So be aware of that. And then there's a side note here I want to mention. If you are not itemizing, but you're charitably inclined, something new that was introduced, you're able to take an above the line deduction for cash gifts up to 1,000 single filers and 2,000 joint. So keep that in mind. If you want to give some money and get a benefit there, even if you're not itemizing, you can do that now again. That brings me to alternative minimum taxes. So just as we were all getting comfortable forgetting about what this was, One Big Beautiful Bill is bringing it back, and more taxpayers are going to be doing this AMT calculation again. So 3 cheers for that. Phase out thresholds were lowered, and the exemption phase out happens faster now. So as a result of this, we're going to see a lot more higher income households being subject to the AMT again starting in 2026. So it is not gone. It's back with vengeance. 40,000 SALT deduction with a caveat, and it's a pretty big one. So SALT deduction increase from 10,000 to 40. This is a huge win for those taxpayers in these high tax states. But before you start high-fiving with all your friends in California and New York, the phase out actually, you have a phase out on this starting at 500,000 of income. At 600,000, you're all the way back to 10,000. And it's temporary. So this is set to go away in 2030 anyhow. So temporary reprieve for a few people, under that 500,000. New deductions for seniors. This is going through 2028, set to sunset in 2028 as of right now. It's a temporary deduction for those individuals over the age of 65. And you're getting a $6,000 additional deduction, 12,000 for married couples if both spouses qualify. And this is available whether you're itemizing or not. That doesn't matter. So if you're not itemizing, you're still getting this. There is a phase out on this that you should be aware of for higher income levels. So single filers starts to phase out at 75, fully phased out at 175, joint starts at 150, fully phased out at 250. So something to watch with your income levels if you're trying to get that deduction. That's all the fun I've got for death and taxes today. I'm going to send it over to Cyrus for something near and dear to my heart, concentrated holdings. Take it away, Cyrus.
Thank you, Ryan. That was really uplifting stuff there. Thanks. But also, on the note of taxes, concentrated holdings, while they are oftentimes a massive windfall for folks who have the luck and the fortitude to hold on to a position as it grows. Maybe it's just a stock that someone made an investment in years ago that's continued to grow. Maybe it's company stock. You can't eat stock. And so as these stocks go up in value and your wealth increases, it becomes more and more difficult to tap into it without having a big tax bill. And that can sometimes cause investors to, just pretty much do nothing. Well, doing nothing is one of the choices, but we want to walk you through the choices. And now that we've started the new year, whether it's the new year, the new quarter, tends to be a better time to sell than right at the end of the year, price notwithstanding, because you get time to try and plan around it from a tax standpoint. So here's some of the options. This is by no means an exhaustive list, but just want to walk you through these options, whether you are someone who has a concentrated holding, someone that does. As we start the new year, just a good time to review the options that are available to you. Obviously, hold is the first one. While there may be a lot of people out there who have these large concentrated holdings in Apple and Nvidia and a lot of these big name stocks, there were at one point people who had large holdings in Lehman Brothers, Enron, Washington Mutual. And so obviously there's significant upside, as we've seen with people who have held on to some of those big tech names, but there can be risk as well. So really the risk of holding is the volatility, that downside risk of owning one individual stock. Selling is the next option, and you look at those two as kind of black and white. You're able to reduce the risk, but then capital gains taxes become a bigger issue. And so selling incrementally over time is a way to help mitigate and somewhat control the narrative on the taxes. Gifting is another option here, whether gifting highly appreciated stock to charity with some of the rules and caps that Ryan had mentioned before. You can also gift to family as well, although they don't avoid the taxes. It's at least a way for you to give some highly appreciated and basically push the taxes to, I've given you money, but now the taxes are your problem, not mine. And then some of the, I think, less common ways that are not the black and white or more often considered hedging and optimizing, which obviously sounds great, but we'll talk about what that looks like. Hedging is a way where you can use option strategies to protect the stock or the position's value. Now, options are very often associated with risk and leverage and, adding a lot of potential upside or downside. However, there are cases where options can be used to hedge and actually protect against downside risk. Not really coming to stock, but Southwest years ago was made a notable hedge in oil prices, where they bought futures at a lower price, and then when oil skyrocketed, they were still able to make a lot more money. So those are examples where hedging can actually benefit you and reduce some of the risk of future uncertainty. But hedging is also insurance, and insurance costs money as well. So just understanding what the risks are associated there, and then optimizing. There have been strategies in place for years, decades, around how to work your way out of a particular stock. There have even been newer strategies in the last couple of years that have come out for ways to work out of larger concentrated holdings. These are generally going to require larger dollar amounts, in some cases even $1 million or more, but there are more options and opportunities out there. One of the longest standing, most common ones are exchange funds, where you basically put in your stock, you have a 7-year lockup period, and then you get a basket of stuff at the end of that. It allows you to basically swap out one holding for a basket of slightly more diversified holdings. But even more recently, strategies like the 130-30, which is a long short indexing strategy, allows them to use your existing stock as collateral and build an overlay to help you get out of that over time in a gradual but tax-friendly way. And then 351 exchange has been an IRS code for a long time, but really starting in late 24, early 25 has gained a lot more popularity, where you're able to actually contribute your stock and make an exchange traded fund out of it. There are upfront costs and some liquidity aspects there. All this to say, we don't expect you to know all the various options that are available to you, especially as newer ones come up. We don't expect you to be able to determine which one is ideal given your specific circumstance. If you have a large concentrated holding, chances are we've already had conversations with you about what that looks like, or employed some of these strategies with you. But if you have a concentrated holding and you haven't talked to us about it, or someone that does, please reach out. There are ways. There's not always one right way, but there are different ways that we can look to help unwind out of that in a tax efficient and relatively safe manner. So that's actually something that Jeff alluded to earlier. Some of our events later this year will be surrounding inviting some of these strategies, folks from these strategies, to talk a little bit more about these solutions. That would be a kind of an invite only event around these concentrated holdings with some of those minimums. But again, if it's something that affects you or someone please let us know, and we'd love to get you added to that invite list. But just more to come on that.
Well, thank you, Cyrus. That was a good dive in. Now, we know that not everything we talk about and every bullet point we make through these conversations is impactful to all of you equally. But one of the things we're very interested in is making sure that we cover a wider range of things, because we know some of these things might stimulate conversations that perhaps we haven't had with you. So for those of you who bear with conversations about tax strategies and concentrated equity, if it doesn't impact you directly, that's okay. Education, I don't think, is ever the wrong answer. And most importantly, back to sort of where we started, is we want you to feel educated and informed, whether that's in the building with us one-on-one or in this format. So for all of you to be through us throughout all these topics is very important. We're grateful to you for that. I'm monitoring the Q&A, and there are a couple of questions. I'm actually getting Q&A coming in on my email and via text. And so I'm a multi-modality guy here trying to navigate all this. One of the questions asked in the chat or the Q&A function inside of the call is fairly robust in its depth. And I think we'll take a shot at answering it as best we can. I think some of it was asked early on, so some of it might have been answered inside of Brent's commentary, but I'll read it. And so perhaps to Ryan, Cyrus, Brent, whoever is interested, the question is, one of the biggest concerns is how we're positioned if foreign selling of U.S. Treasury bonds alongside increased central bank gold accumulation leads to higher yields on bonds, which means lower prices, and as a byproduct, potentially tighter liquidity, and probably most important to a wider swath of people, all that leading to a repricing of equity, i.e., stock valuations. So the question is really, are we set up for some type of storm that could impact portfolios in a meaningful way? So if anybody can respond to any, all of that in less than 10 seconds, no, I'm just kidding, in an appropriate manner, that would be great.
I'll get a couple comments on that, which I hope answers your question. So, one thing, bond market's big, giant, huge market. One thing the Fed can control is they can control the short end of the yield curve. They can set that overnight rate, which is what they're doing now to make that, and they can just show up as a buyer last resort. That would actually be very inflationary across it. Let me backtrack. The type of scenario that you're describing where every single central bank in the world decides they want to dump US Treasury bonds and buy gold, you're seeing a little bit of that, more in the sense of it, not that banks are actively selling their bonds, but they're letting some of their existing positions roll off. And they're definitely increasing their precious metals assets, no question about that. But typically what they'll probably do is just let the bonds roll off, continue to collect their interest, and maybe they're just not as aggressive as buyers. But in this scenario where they don't show up, the debt's going to get financed somehow. Typically, the way that happens in not great scenarios is the central bank finances it. And what that does is just dilutes the value of your dollars. And the natural entry point to that tends to be real assets. It tends to be equities. It tends to be stuff and things that you can hold. It tends to be bad for if you're holding a ton of cash in the bank. It tends to be bad for if you're owning bonds that mature way out in the future. To how we've addressed that, inside our alt sleeve, we have real assets in there. Our U.S. exposure is markedly lower, I would argue, than most of our peers. Meaning we have more international on in a weak dollar scenario. That's a tailwind for us, which is a big thing. And the duration, meaning the average maturity of our bond portfolios, tends to be lower as well. So it's lower than the aggregate bond index, which means it's a little less sensitive to that kind of scenario.
And more can be detailed, but Ryan's got something to chip in as well, which I'll let him layer in.
Yeah, I just echo what Brent said. So if in this type of an event, it's actually would bode well for U.S. stocks. So if you think we always heard China's devaluing their currency and that's, this big competitive advantage that they're getting by doing that. So just think of that in terms of if the dollar is going down, it would be a competitive advantage for us in stocks specifically. So, and the other part of that is you've got 65% of that debt is held in the United States, 35% outside 40% of that is European countries that are allies, at least still, at this point. And then there's a really large swath that's outside the US in pension funds and endowments. And there's really not a great alternative for this. So it makes it we're the best house in a crappy block kind of a scenario. So not overly concerned. There's not a really great solution to this at this point.
We've got a late entry to the Q&A, and I actually love the question. So I'm going to ask it live and see what we've got. We've got a great brain trust here. So question is, how do we plan to manage around inappropriate manipulations of stock markets by politicians as it relates to both the Fed and invented or real crises that drive market, then the crisis is resolved for recovery? How do we navigate around exogenous events, particularly as it relates to the political environment? If anybody wants to jump on that.
Jeff, I will give this one a shot without getting political. I think it's important as we meet with all of you, the most important conversation we have is understanding what the risk of your portfolio is. Because whether it's something that we might be expecting or something that we don't expect at all, the one thing we know is there will be another downturn in the market coming. We saw it play out last year, and we saw that the recovery was fast. For those who were comfortable enough staying in the market, they were able to reap the benefits of that faster recovery. For those who were not comfortable and sold out, they weren't able to participate to the extent when that recovery occurred. So I think the most important thing, regardless of political party or belief, is making sure that you have a portfolio that not only aligns with your goals, but your comfort level and your risk tolerance as well. The worst thing to a plan is abandoning the plan. So we have mechanisms in place in the portfolio. We've added things like alternatives and other ways to hedge, to reduce the volatility, which hopefully you all saw when things were happening last March and April. But I think the most important thing is just understanding risk involved in your portfolio. We want to be here to help, hold your hand or talk you off a cliff if the time comes. But I think that's really the thing is being comfortable with what you have before any event, expected or unexpected, comes to shock the markets.
Thanks, Cyrus. I'll give a real world example from my meeting earlier this morning. I had a retired couple in here, and the topic came up in reviewing performance for 2025. And when I showed them that the middle of the road portfolio that they own as retirees, which is not supposed to take a bunch of risk, during April, when the tariff tantrum, as I like to call it, happened, and the S&P was down 15% and the NASDAQ was down 21%, their drawdown in April at its worst was 2.62%. Now, that's specific to one particular client. That's not everybody's experience, but I can tell you that every portfolio that we have in our suite of model portfolios models that we offer has a risk tracking metric to it. And we can show you in individual one-on-one meetings how much volatility was associated with our portfolio return last year. Because what we've always focused on across all of our practices is the idea that returns are a byproduct of time. Risk is in fact what we can control in the shorter periods of time. And last year, particularly April, is a great example of that. And we're more than willing to do it with each and every one of you who are interested in that exercise, a regular course of our reviews with you in 2025. So we are at the 47-minute mark. I can't believe it. We've answered a couple of very deep questions. For all of you who are here, we are grateful again for your participation. If any questions come up that you want to ask on top of this, hopefully you know how to get a hold of us. After all, you found us here. And I would like to say on behalf of all of us, our team here, our growing team, that by the next time we do another town hall, will join us and probably do some introductions. We're so grateful for the time spent. We know, particularly for some of you, it's quitting time and dinner time on the East Coast. So for those in different time zones that have joined, we're grateful for that. For all of you, we don't get to do any of this work without the implicit trust that you put in each of us and all of us together. So I would say on behalf of the team here that grows and continues to serve you, we're so grateful for your time. We'll catch you on the next town hall, and anything in between you need, come find us. Have a great night.